How much of these U.S.-China tensions have already been priced into the markets?
You know, it's a reminder that we spent all of our time before we ever heard of COVID-19 focused on these U.S.-China tensions, on the negotiations, on the tariffs, and on the supply chain disruptions. Clearly, none of that went away in the meantime, even as the U.S. is emerging from the pandemic. And these are issues that are going to be front and center. I think companies all along have been sensitive to the fact that they need to think about their supply chains, think about maybe diversifying their supply chains. But I think overall, most of the restrictions are going to be focused, well, there are the tariffs that are very broad and already in place. The restrictions in terms of more specific kinds of trade are really focused around technology, dual use goods. And that's why I think you're seeing, this extension of the Trump era ban on companies that have links to the Chinese military. I'll just say one more thing, though. The Biden approach, while very similar in terms of putting pressure on China, I think this time is also trying to work with Japan, with Europe, and other allies to sort of present a concerted front that is not aimed necessarily at punishing China, but aimed towards making progress. So the real test of the current decisions will be whether it yields anything new in the months ahead.
Does that sort of mitigate the risk perception for the markets then?
Well, I'm not sure this is a central risk for markets right now. Markets are still so driven by COVID, by monetary policy, and by fiscal policy, particularly in the US, but also in Europe and China. These are risks that may be very sector specific and company specific if tariffs come back on. If certainly companies are delisted, that's obviously very important for those particular investments. I'm not sure it yet has the level of something that will change the trajectory of the market by itself.
When it comes to the rerouting of the supply chains, this will increase costs for companies, right? Are you pricing that into your calculations right now, or has that already been priced in? And I ask this at a time when, of course, we are continuing to see global chip shortages.
I think everybody's got to price that in, because I think those are the risks that have been building over the last couple of years and certainly remain in place. I think markets have come to the conclusion, even before the election, that the Biden administration wasn't going to rush to take tariffs off. I think companies had already started shifting a lot of their production out of China for cost reasons that we've seen. And I think it really is a company by company decision. Having said that, the U.S.-China economic relationship is still the largest bilateral economic relationship in the world in terms of trade and in terms of investment. And that's not going to go away. There will still be very large flows of money going back and forth, even if certain sectors, I think, are disrupted.
Christopher, when you take a look at the structural direction of the US dollar, some of the comments from the Fed that we've been getting that may or may not, clarify the picture when it comes to monetary policy going forward, how do you assess the risk for emerging markets?
I think the biggest risk for emerging markets is a sharp rise in U.S. yields. Our view at Barings is that there is, obviously a secular recovery, that things are reflating. We're going to see some short-term inflation numbers, at least next week. We may get some that spook the market with U.S. CPI estimates at 3.5% right now. But I think the biggest risk for emerging markets is that data starts to spook bond yields higher, which will drive more money coming into the U.S., generally out of emerging markets. Stronger dollar obviously makes dollar-denominated debts for emerging markets heavier to bear. But I think generally the view would be that this is going to be something that takes place relatively gradually over the next year or two, and that emerging markets will, as they themselves recover, hold their own, and that there are obviously a lot of one-off risks in places like Turkey or Ukraine or Peru for local reasons. But overall, we think that they can weather the reflation of the global economy.
We are just hearing, and it's not surprising, but it's just a development, I suppose, the extension of how long it might take for international borders to reopen. We're hearing from government ministers this morning in Australia saying that it could be mid-2022. Some people were saying by the end of 2022 that we'll finally see international borders reopen. Australia is, I suppose, a different case in one sense, but what does this say more broadly about the disruption to the flow of people globally and the way that consumption happens, as well as, the notion of globalization, if this aspect is not going to be normalized post-pandemic for some time to come?
I think that's a great question. I think it really deserves a lot more attention than it's been getting. As there's been so much excitement, I think, and euphoria in the US because vaccinations have been rolling out, and it seems as if the economy is really opening up to a very strong summer and fall, and Europe is coming in behind. I think we're very closely watching things like the news out of India, South Africa, other countries, and it is a fresh reminder that normal isn't going to be fully normal until there is this global travel of people, not just goods. I think, as we look at various transportation industries, if you're in the business of moving things, business is booming. If you're in the business of moving people, we've got a long way to go. And I think that will have some, at least in the near term, impact on reshaping demand for particularly tourism, hospitality, and that sort of thing.